Welcome back, guys, to another Lux Trades education session where we're going to teach you how to become good traders. Today, we're going to talk about consolidation zones. We've seen a lot of consolidation zones on SPY. So yeah, let's get into it. What is a consolidation zone? Consolidation zone refers to when trading, there is an area where the asset's price moves in a very narrow range without a clear direction. It usually occurs when buyers and sellers are in an equilibrium or cannot decide one direction. This results in a sideways movement of price, as you see here on that graph. Price is moving sideways and not up nor down rapidly. Consolidation, right? Some of the characteristics you can look for are range-bound movement, which the price will fluctuate between a defined support and resistance level, and those support and resistance levels are usually somewhat close together, as you also see in this graph. So price somewhat close together, and we're just moving in between. That is a zone of consolidation, a zone where price hasn't broken out to one direction. All right, next we're going to talk about low volatility. So usually in consolidation zones, there's low volatility. This isn't always the case, but most likely you're going to see low volatility when you're in a consolidation zone. Maybe we have a high volatility buy-up, and then we get in a consolidation zone where volatility completely drops, and we're just slowly moving in one area, okay? Decreasing volume as well. That kind of goes along with low volatility. So there's less people in the markets in that consolidation area. Price hasn't decided where to go, so it's just bouncing in one area, right? It hasn't it's consolidating, hasn't broke out to one direction. And then this is right before a breakout, so it precedes breakouts. Consolidation zone right before breakout. If you are going to have a breakout, most traders look for those consolidation zones. They're wanting a breakout. All right, next, why do consolidation zones matter? So why it matters is because traders are watching for those breakouts, like I just said. Of course, you can trade sometimes within the levels, but what we want is those breakouts, because with those breakouts, we have more confirmation and we have the potential to move way farther and then also make more money. So support and resistance levels within the zone help us make those short-term trades. So as you see, when we come up to this resistance, we bounce off it. If I wanted to take puts at that resistance level where we keep bouncing off, I could take puts off resistance and then hold them to my support. That's another way you can trade. And then, like we talked about before, this is just saying the market is in indecision. The market cannot decide what to do. Are we going to be bearish? Are we going to be bullish? We don't know. It is indecision in the markets. All right. Emmanuel?
So what are some strategies that we could use for consolidation zones? Starting with the first one, it's kind of obvious. I'm gonna slide to this slide we were just at to show you for an example. So basically, what you would do is like you buy a call here, right? Like if you know it's consolidating, maybe after like the first like one or two ups and downs, you would buy like a call at support, which is the bottom, right? You buy a call, you sell resistance. You could do that over and over, rinse and repeat. Same with puts. You buy puts up here, sell them down here. You could buy a call here, sell it up here, buy a put. That's a tactic that some people could use. That one's called the iron corridor. It's steady, but you don't get as much money as you would get, with a long stick pause. The risks of it is that if it breaks out in any direction, you could either lose a lot of your money or you could get lucky and win a lot of your money. That is if you forget to sell. So it's more of like I don't know. I personally wouldn't use it just because it's like too much work. It's like having to like put in too much effort for something that is probably not going to be worth it and has too much of a risk to like cost you more. The second one is straddle. This one's best for like bigger moves. So what you would do is like you buy a call option when you feel like it's going to go all the way up, or buy a put when you feel like it's going to go all the way down. And for example, in this one, I would say, okay, well, it looks like up here we came from a higher range, right? So we came down here, started consolidating. I'm like, all right, I feel like this is gonna go down. So maybe even over here or down here, I would buy a put and I just hold it. And I wait all this time and eventually it's gonna go down. That's what the straddle would be. And it works because, if you were to buy both of them at the same time, whichever one goes in it, like say you buy a call and a put, right? They're both worth 120 bucks. Say it goes all the way in the upside. The call might gain 200, but the put can only lose 120. That's kind of like what it is. So the profit from it is like, you could really get unlimited money, but it's not going to be as much because you're also losing some of your money. And then the risk of it is that if the price were to stay in the same range and it lasts over time, you're going to lose the money from both the call and the put. So me personally, I'll never use a straddle, and I've never used a straddle. But it's a technique that lots of people do use when they really like know it's or assume it's going to break out crazy in any direction. And then the last one is the strangle. So this is like when you expect a breakout, but you're looking for like a really like cheap, like a cheap call or a put. So what you would do, for example, again in this picture that we got here, let me show you guys in the chart. What you would do is, for example, say we're looking at this NVIDIA chart right here, right? And I know it's gonna go down because it just looks like it's gonna go down. I'm like, shit, it's just looking weak today. Like, I don't know, I don't really trust this stock today. What I would do is, say we were up here and the price is $122, right? I would probably buy a put for like 119, which would be a lot cheaper. It'd probably be like 50 bucks compared to like 120 bucks or 200 bucks. I'd buy a put for that price, and then I just wait. And then once it gets there, that put, would gain value. Same for the upside. So like, for example, right here, we have another kind of like consolidation zone where it goes up, down, up, down, up. And then right here, you could see like, you could assume it's going to keep going up a little bit. So somebody in any of this range right here within these two lines could say, you know what, I want to buy a 123 call. I know we're not there yet, but I see the movement going up there, so I'm going to do it. And then you would buy it, and then once it gets there, you sell it, and you make your profit. Yeah. That is what I personally used the most, but I don't really use a strangle. Like I don't usually like get cheaper calls or puts. I'll just assume where it goes, and like sometimes I'll just buy a put or a call, and I'll say like I'm just gonna hold this because I know it's gonna go up or down. And like sometimes it takes longer. I buy it too early, but if you know where it's gonna go and it's just a consolidation zone for a breakout, you know what I'm saying? Like it's really like up to you when to get in. I just get in whenever I feel like it, and usually I'll make some money from it. Like it's not really hard to deal with these consolidation zones, but these are just some ways to deal with it that can be cheaper or easier or less risk. All right, final thoughts on trading consolidation zones with options. So like it's an opportunity. Most people see this as like, fuck, the market's stuck, it's not moving, like this is crazy, like I'm not making any money. That's a pessimistic way to view things. You can make money no matter how the market is moving. Second, if the stock is likely to stay in range, you can still make money. Like for example, that iron corridor strategy where it's just like you buy, sell, buy, sell, buy, sell. I've done that before. We actually did that at Lux when we first started. The market was extremely consolidated, and that's what we would do. We would just buy, sell in the same range. And then, last thing, something that we always say is, you always want to manage your risks because at the end of the day, no type of trading is going to be 100% safe, and it's always going to be a risk to it. With consolidation zones, the biggest risk is time because the whole point of consolidation zones is to make puts and calls worthless because over time they lose worth. And the longer you stay in, the more value you're losing. So it's about being quick and agile with it. Buying low, selling high, quick. You don't want to hold too long. Unless you expect to break out really well, you don't want to hold too long. You want to make sure you get in, get out, get in, get out. If you're going to do that. Lots of people just stay out of it. But yeah. Now I'm going to show you some examples like we were doing before. I'm going to have Sam show the first one. Hold on. I have an example here on SPY. This one right here.
All right, bet. So, yeah, as you guys see here, we've came from a strong sell-off. So we had a strong sell-off right before this. And then what do? We come in a zone, like these two parallel lines. What are we doing? Price bouncing up, down, and then you see it looks almost like a barcode. In this case, it's actually very volatile. It's usually not. But look, we can't barely trade this because price is staying in a very tight area. It's hard to predict what price is actually going to do here because we haven't came into one area. And as you see, it almost stays perfectly in between these lines. All right. And looking at this as a trader, how would we want to trade this? So we had strong sell-off, and then we start to consolidate in here. And then we get really choppy. We're bouncing up and down, up and down. If you want, look at puts from the top of that resistance level to the bottom. That is a good trade right there. To be honest, you guys, in one chart, in one specific set of time, there is hundreds, if not thousands of trades that you can take. There's not ever going to be one trade that's the correct trade. That's just the reality. There's many correct trades. You just have to be able to spot them. So yeah, you can do that strategy. However, when we go look at that breakout, it's incredibly strong. What I like to do personally is I buy down at that support level, and if I think it's going to be bullish, I will just hold and see if it wants to reject. And if it doesn't reject and breaks out, I'm like, bam, okay, I'm in the trade. We're going up. But if you want to have like a little bit of confirmation right after that breakout, look it. We get above that resistance, and what do? We wait for a break and hold. Guys, it's important. We talk a lot about this when we are just doing our normal day trading. We're waiting for breaks and holds. So what did we get with that candle right above that support level? We had a break, and the candle held. The candle closed right there. What happened the second that next candle closed? To the moon. That candle was absolutely massive. What? That's like almost a whole dollar in one candle. So that's what we're looking for. We had consolidation followed by a breakout to the upside, and then bam. So that's how we would trade that. That's how we identify it. Emmanuel, you got another example for us?
Yeah, and I also wanted to add, if you guys have been paying attention, this right here that we're seeing, like right here, literally this consolidation zone, is a perfect example of a bull flag. Like we went through this in a different class. A bull flag usually has like this downward kind of like like a bull trend, like a bullish trend. It has like this downward kind of momentum, and you know that when it pops out, it's gonna pop out. And we see this very often. Same with this right here. So like for example, this one, it went up and it looks like it would be a bearish flag. However, it did end up coming back down. Like you could peep these things and assume already where it's gonna go. Like there's certain things that market tends to follow really well, and certain things that like you can also just use your common sense to assume. But yeah, let me see if I could find another example real quick. This is when we were at all-time highs, by the way. Like literally a week ago, maybe. All right, this right here is an example of like consolidation. This is more long-term consolidation. So this is like what people would be stuck in for hours. And like you kind of don't want to be stuck in these. You can make money off of these more than you can make on the ones that we just showed because it's more volatile, but it's going to take longer. So here we could see that we start consolidating from about here all the way to here. So let me draw like the, yeah, I'd say like, all right, so we got this area right here. We're bouncing up, down, up, down, up, down. Now, we did have a previous sell-off before we got this. And we see this area, it's bouncing up, down. This is what I would do. This is how I would take this trade, right? So I see this selling off, and then I see this jump. It jumps here, not quite high enough to like go back to previous, but it jumps pretty high. Then it sells off. Here you could easily make some quick money off of a put. It goes back up higher than the previous one. So at this point, anybody could assume that this might jump up higher. However, then when it comes back down, you see this like there's like a resistance here. It starts climbing back up. This time it's more steady. But as you guys could see, it doesn't quite reach that higher high. This was one of our first lessons. This right here, what you guys are seeing right here is called the head and shoulders. You got one shoulder here, one head here, and another shoulder here. When you see a head and shoulders, it's going to go, like if you see a head and shoulders like normal, like this, like up, it's because it's going to go down. And there's inverse head and shoulders, where it's the opposite. That's the head, it's like flipped, and it'll go up. So this is very clearly a very bullish signal. So, I mean, bearish. So when you see this, when I would see this, I say, okay, well, this one didn't go as high as that middle one. And this also looks just like a head and shoulders. So I would buy puts anywhere around here. Anybody who bought puts around here, look, how much money is that? We're at 610 right here, 668 right here. crazy. You know what I'm saying? You could almost like 2 times any put in that amount of time. And this probably wasn't even that long. Less than an hour. You know what I'm saying? That's how I would do it. That's why consolidation zones aren't something to be like, fuck, I'm not gonna make no money, or fuck, this is wasting my time. It's about being patient, first of all, analyzing and executing. Don't be scared of these. Don't worry about, man, I don't know if this market's even gonna go anywhere. Like, they're just, they're burning out my calls or my puts. Then you should have hopped in later. You hopped in too early. You feel me? But essentially, they're pretty easy. They're pretty easy to deal with, and the more you deal with them, the easier it gets. But yeah, that's about it for today. If you guys have any questions, let me know. If not, I hope you guys, enjoyed class today. And, I hope you guys took notes. If not, you guys should go back and take notes when you can. Notes are very important. But yeah. All right.